January 2nd, 2026. Not in a boardroom. Not on a trading floor. In inboxes. While most of the world is still shaking off New Year's fireworks, procurement managers across the United States, Europe, and Southeast Asia are staring at the same sentence, arriving from different addresses, written in different tones, but carrying one identical meaning. No. No shipment. No allocation. No workaround. No silver. As I'm recording this, the reports are not developing. They are landing, one after another, like denial stamps hitting paper. Industrial buyers. Supply chain directors. Electronics manufacturers. Solar procurement teams. Battery suppliers. People who don't do panic. People who don't speak in emotions. And yet the messages read like an apology from a world that just changed its rules overnight. Due to new Chinese government export licensing requirements effective January 1, 2026, we are unable to fulfill your order. It's the kind of line that seems boring until you understand what it really is. That sentence is not customer service. It's a border. Because the January 1, 2026 Chinese silver export licensing system wasn't designed to be navigated. It wasn't designed to be negotiated. It wasn't designed to be softened by relationships or the right contact. It was designed to be enforced. And it went live at midnight, Beijing time, like a light switch. In the last 36 hours, the first wave has already hit: customs rejections, contract cancellations, and denial notices that Western buyers assumed would never come. Not because they were careless, because for 20 years, the system rewarded the assumption that refined silver would always be available if you paid for it. That era just ended. For months, we warned that China was moving to lock up its refining capacity. We covered the earlier announcement of the licensing framework. We walked through the thresholds: 80 tons minimum annual production and $30 million credit line requirements, and we explained why that wasn't a technical filter. It was a weapon. It disqualifies hundreds of smaller and mid-sized refiners and trading houses by design. It consolidates export permission into the hands of a few giants, many of them aligned with state priorities, and turns what used to be commerce into something else entirely. Permission flow. Until January 1st, there was still hope that enforcement would be loose. That existing contracts would be grandfathered. That important customers would be quietly approved. That hope is now gone. Not because the policy exists. Because it's operational. Let me show you how we know. The first denial: a U.S. manufacturer hits a wall. Report 1 comes from a mid-sized electronics manufacturer in California: circuit boards for automotive suppliers. This is not a meme stock story. This is the invisible industrial spine of the modern economy. They've sourced refined silver from a Shenzhen trading house for 8 years. Their quarterly order is routine: 180,000 ounces, the kind of volume that never makes headlines because it usually moves smoothly. On December 27th, they submit their Q1 2026 purchase order like they always do. On January 2nd, the reply arrives. Not a negotiation. Not a delay. A denial. The supplier says they do not qualify under the new export licensing requirements. They can't ship. They'll refund the deposit. Please seek alternative suppliers. So the California manufacturer does what professionals do: they call backups. They contact 3 other Chinese trading houses they've worked with before. All 3 respond with nearly identical language. We do not qualify. We cannot export. Now the manufacturer tries to pivot to domestic sourcing, U.S. dealers, alternative channels, whatever can deliver metal fast enough to keep production moving. And what do they find? Delivery times: 18 to 24 weeks. Premiums: $32 to $45 over spot. And the most humiliating part of modern supply chains. Even if you have the money, you can't buy what isn't available. This is where the story stops being about prices and becomes about time. A factory can survive expensive input costs for a while. What it cannot survive is not having the input at all. The second denial, Europe realizes the contracts don't matter. Report 2 comes from a German solar panel manufacturer, operations across Europe, sourcing solar-grade silver materials through a refinery in Guangdong that specialized in the purity they needed. Annual contract, 2.4 million ounces. On December 30th, the notice arrives. The refinery's export license application was denied because their production capacity is only 62 tons, below the 80-ton minimum threshold. And that's the genius of the mechanism. It doesn't say, "We don't like you." It says, "You don't meet the criteria." It turns a political decision into a compliance outcome. Contract terminated. Effective immediately. No future shipments. The German manufacturer has 6 months of inventory. After that, the lines stop unless new supply is found. So they do what every CFO will do in the next few weeks: they call Australia, Canada, Mexico, anywhere outside China that can refine at scale. And they are told, again and again. 90% of production is already allocated under multi-year contracts signed in 2022 to 2024. Which introduces a brutal truth most people don't understand until it's too late. In commodities, the available supply is not the total supply. It's the uncontracted supply. And that pool is tiny. The available spot production from non-Chinese refiners globally. Approximately 15 to 20 million ounces annually, in the story we're tracking here. Now consider the psychology of that number. One German company needs 2.4 million ounces. If 10 companies call, the pool is gone. If 100 companies call, you don't have a market anymore. You have a queue. The third denial, even the licensed exporters are choked. Report 3 is the one that should scare you the most, because it reveals the final layer of control. A Japanese battery manufacturer, supplying major automakers, has sourced from a major Chinese state-owned refiner for 12 years. This refiner does qualify for an export license under the new system. It meets the thresholds. And yet the notification includes a clause that changes everything. Export contracts are now subject to government approval shipment by shipment. Priority goes to domestic manufacturers and strategic partners. Export allocations will be determined by diplomatic considerations and trade balance factors. So the Japanese manufacturer requests approval to export 450,000 ounces in February. And on January 2nd, the request is denied. No explanation. No appeal. No legal mechanism to force approval. This is what licensed really means now. You may export, if the state decides you should. The pattern in the first 36 hours. These aren't isolated stories. In the last 36 hours alone, the reports multiply, 17 similar accounts and rising. Different industries, different continents, same outcome. Chinese refiners are either disqualified by design, or licensed but throttled by discretionary approvals. The end result is identical. Western buyers cannot get silver out of China. And this is where the story shifts from supply disruption to structural rupture. Because China doesn't merely mine silver. China refines the world's silver. And refining is the choke point, where raw material becomes usable industrial input. For 3 decades, China built this dominance like an empire builds ports, infrastructure, expertise, scale, cost advantage, and relentless expansion. Western manufacturers benefited. Miners benefited. The system became normal. And then the system ended. Not with a war. Not with a speech. With a licensing switch at midnight. In part 2, we're going to quantify what just disappeared from global trade, and why the math doesn't just look tight, it looks impossible. We're going to connect this directly to the vaults, the delivery mechanisms, the hidden stress fractures in paper markets, and why an export rule becomes a repricing event. Because this isn't just about silver becoming expensive. It's about silver becoming unavailable. And when the world's most important supply chains begin to run on unavailable, economies don't adjust smoothly. They break. When people hear export restriction, they picture a delay. A paperwork bottleneck. A temporary hiccup. Something that gets solved by calling the right broker, paying the right premium, or rerouting through a friend of a friend in another port. That mental model is comforting. It's also wrong. Because what went live at midnight on January 1st wasn't a speed bump. It was a gate, and the gate was built around the only part of the silver supply chain that actually matters to modern industry. Not mining. Refining. Silver ore is mined across the world: Mexico, Peru, Australia, the United States, Canada, Poland, Russia. On paper, it looks diversified. People see that list and assume safety. But here's the reality beneath the headlines. A huge portion of that ore does not become usable metal where it's mined. It gets shipped, quietly, routinely, into Chinese refining capacity, because that's where the smelters, the chemists, the scale, and the cost structure have lived for decades. And China didn't take this dominance overnight. They built it the way empires build naval control, slowly, relentlessly, and with state patience. Infrastructure. Specialist training. Environmental trade-offs the West didn't want politically. Subsidized scale. Tight integration with downstream manufacturing. So now when China turns the tap, it's not turning off Chinese silver. It's turning off the world's access to refined silver. And that distinction is everything. The number you need to hold in your head. The script we're following puts it bluntly: China controls approximately 60% to 70% of global silver refining capacity. Again, refining, not mining. Now let's map the implication. If global refining output is roughly around 1 billion ounces annually when you include primary mining, byproduct recovery, and recycling, then China's refining machine processes 600 to 700 million ounces per year. Not all of it is exported. China uses plenty domestically. But the critical point, the pressure point, is the flow that used to leave China and fill Western industrial demand. Conservatively, the script estimates that around 400 million ounces annually used to flow from Chinese refiners into global trade to Western buyers. As of January 1, 2026. That flow stopped. Stop and let that settle. Because the mind will try to shrink it into something manageable. But 400 million ounces a year isn't tight supply. It's a missing artery. The vault comparison that exposes the illusion. Now we put that number next to the thing everyone in the paper market worships. COMEX registered inventory, the silver, available for delivery, against futures. The script cites COMEX registered at 38 million ounces at that moment. And suddenly you see the scale mismatch. China removing 400 million ounces annually from global trade is not just larger than COMEX registered. It's more than 10 times that registered stockpile, every single year. So when someone says, the market will adjust, you're forced to ask. Adjust to what? Because markets adjust through substitution and reallocation. But this is where the physical reality becomes merciless. Why Western buyers can't just replace China. The naive response is always the same. If China won't sell, we'll buy from somewhere else. Or we'll build our own refineries. That's how people talk about widgets. Silver isn't a widget. Refining capacity is not elastic. You can't summon it on a quarterly earnings call. Building a new silver refinery from scratch takes 5 to 7 years minimum, and that's in a best-case political environment. Permits. Environmental impact studies. Design. Construction. Hiring. Training. Securing feedstock contracts. Building logistics. Quality assurance. Regulatory compliance. Capital expenditure in the tens, often hundreds, of millions. Even if a Western firm decided today, January 2, 2026, to build a refinery capable of meeting China's own threshold, you're looking at 2031 or 2032 before it's operational. So the question becomes brutally immediate. What do manufacturers do between now and 2031? They don't get to wait. Factories don't pause gracefully. They don't say, see you in 6 years. They shut down. Or they move. Which is exactly why the timing matters. The real bottleneck, uncontracted supply. Here's the part that breaks people's mental model of commodities. Most refining output outside China is already spoken for. Multi-year contracts. Locked allocations. Mines committed to refiners. Refiners committed to industrial buyers. Matching timelines. Penalty clauses. Relationship chains that were negotiated when nobody believed the tap could be turned off. And the script gives a number that should feel insane once you understand the demand side. The available spot production from non-Chinese refiners globally is approximately 15 to 20 million ounces annually. That is the free float. That is what's left after the world supply chain commitments are already made. Now remember what was lost. 400 million ounces annually of Chinese refined flow removed from global trade. So Western buyers don't switch suppliers. They all stampede into the same tiny pool, 15 to 20 million ounces, like a crowd trying to fit through a door designed for 20 people. The demand side, why this becomes a panic, not a price. The script drops a set of examples that illustrate the asymmetry. Samsung needs 50 million ounces. Tesla needs 38 million. First Solar needs 42 million. Nvidia needs 23 million. That's 153 million ounces across 4 names. And we're not even counting the dozens of other major industrial users. Add them up and the script frames it as 400 to 500 million ounces of Western industrial demand suddenly forced to compete for a sliver of non-Chinese availability. Now stack that against 20 million ounces of uncontracted non-Chinese refined supply. That's not a tight market. That's a structural mismatch, 20:1, 25:1. And in markets like this, price doesn't simply rise smoothly. First, access becomes political. Second, allocation becomes strategic. Third, the paper price detaches from physical reality. Which brings us to the fuse that was already burning before the export gate even closed. COMEX. Why this snaps back to COMEX immediately. The script connects this directly to what you already covered, Samsung's scramble and the leaked memo. Samsung asked COMEX for 50 million ounces and was offered 5.2 million. That wasn't COMEX being stingy. That was COMEX doing math. Because COMEX understood what January 1st meant. Hundreds of industrial buyers, who had relied on Chinese refined silver, would be forced into the last liquid Western channel. COMEX isn't the source of silver. It's the emergency valve. And emergency valves aren't designed to feed an entire industrial civilization for months. They're designed to equalize pressure until something else changes. But now nothing else can change fast enough. So what happens? The script frames it like a sequence. China restricts exports, Western buyers panic, COMEX delivery demands surge, vault drains faster, scarcity becomes visible, panic accelerates. That's not a theory. That's a loop. And when loops like this go public, they don't unwind politely. They cascade. In part 3, we go into the collision point, the delivery demands, the future structure, the vault arithmetic, and why the paper market can hold together only as long as the world believes physical metal is available somewhere behind the curtain. Because the moment industry stops believing, the curtain gets ripped down. Every commodity crisis has a moment when abstraction dies. A moment when spreadsheets stop working. When models break. When assumptions that held for decades collapse in a single delivery cycle. For silver, that moment has a date. February 12th. And what the Chinese export ban did, quietly, surgically, was pull that date forward by weeks. The illusion that paper can absorb reality. For years, the global silver market lived under a shared illusion that physical shortages could always be absorbed by paper mechanisms. Futures contracts, cash settlement, rolling positions, inventory somewhere. As long as nobody needed the metal immediately, the system functioned. It didn't have to be honest. It just had to be liquid. But industrial buyers don't operate on belief. They operate on deadlines. A factory that can't get silver in February doesn't care about March contracts, ETF inflows, or theoretical inventory in London. It cares about metal now. And that's where the futures market stops being a hedge and starts being a battleground. The March 2026 trap. As we move into early January, the March 2026 silver futures contract becomes the focal point, not because speculators love it, but because industrial buyers need it. The script outlines the numbers with chilling clarity. Roughly 145,000 March contracts open. Each contract represents 5,000 ounces. That's 725 million ounces of delivery rights sitting on the books. Now, nobody expects all of that to stand for delivery. Historically, only a fraction does. But here's the mistake analysts keep making. They're using historical percentages in a non-historical environment. Under normal conditions, maybe 5 to 10% stands for delivery. But these are not normal conditions. The script previously estimated 60 to 90 million ounces might stand for delivery based on known industrial demand. That estimate was made before the January 1st export ban went live. Now add this. Every Western buyer who assumed Chinese silver would fill Q1 and Q2 orders has been cut off. They don't have time to negotiate 5-year refinery builds. They don't have time to wait for spot allocations. They have production schedules that don't care about geopolitics. So where do they go? They go to the only place where delivery is contractually enforceable. They go to COMEX. And they don't go politely. Why? COMEX was never built for this. COMEX is not a warehouse system. It's a clearing mechanism. Its registered inventory, 38 million ounces at the time referenced in the script, is not a strategic reserve designed to support global manufacturing. It's a buffer. A shock absorber. And buffers work only when shocks are brief and limited. Now consider the revised pressure. Instead of 60 to 90 million ounces standing for delivery, the script argues the number could jump to 120 to 180 million ounces as industrial buyers pile in, desperate to secure whatever metal they can before the window closes. That's not stress. That's failure. A vault with 38 million ounces cannot satisfy delivery demands 3 to 5 times its size, especially when those ounces are already being drawn down daily. Which brings us to the number almost nobody outside the industry understands. Drain rate. The drain rate nobody is pricing in. In late December, COMEX registered inventory was draining at approximately 847,000 ounces per day. That was before China locked the gate. The script projects that rate accelerating to 1.2 to 1.5 million ounces per day as January progresses. At that pace, the math becomes terrifyingly simple. 38 million ounces divided by 1.4 million per day equals less than 30 days. And that assumes no surge. No panic. No coordinated industrial grab. Just steady, relentless withdrawal. Which means the vault doesn't need to hit zero to fail. It just needs to hit a level where confidence breaks. When confidence breaks, rules change. Here's what happens next, because it has happened before, in other metals, in other eras. First, COMEX doesn't announce a crisis. It announces measures. Margin requirements quietly rise, from $8,000 to $15,000. Position limits are introduced. Delivery windows are extended. Cash settlement incentives appear. All of this is framed as market stability. But to an industrial buyer, it means one thing. The contract no longer guarantees metal. And the moment that belief spreads, the futures market stops being a hedge and becomes a risk. The script lays out a chilling timeline. Late January, vault below 30 million ounces. Margin hikes squeeze speculators out, leaving mostly industrial demand. Position limits cap large buyers, no one allowed to take more than 1,000 contracts. Buyers fragment demand to try to slip through the gates. This isn't speculation anymore. It's desperation. February 12, the collision. By early February, registered inventory could be down to 18 to 22 million ounces. Open interest in March contracts drops as speculators flee, but what remains is worse. Industrial buyers who must stand for delivery. On February 12, delivery notices are filed. Total demand, 80 to 120 million ounces, possibly more. Available metal, a fraction of that. This is where the system faces its moment of truth. COMEX can deliver metal it doesn't have. Or change the rules. History tells us which one it chooses. Emergency measures. Cash settlement. Force majeure language. Quiet negotiations behind closed doors. And once that happens, something irreversible occurs. The futures price becomes informational, but no longer authoritative. The real price moves elsewhere. The doom loop activates. The script describes it as a loop, and that's the right word. China restricts exports. Western buyers panic. COMEX deliveries surge. Vault drains faster. Scarcity becomes visible. Confidence collapses. Demand accelerates. Rules tighten. Physical disappears. Price detaches. Panic spreads. This is not theory. This is the same structure we saw in oil in the 1970s, in nickel in 2022, in gas markets during wartime. The difference? Silver sits inside everything. Which means when silver breaks, it doesn't stay in the commodity pit. It moves into factories. Into layoffs. Into GDP. Into politics. In part 4, we're going to step outside the vault and follow the panic outward, into retail dealers, into premiums, into the moment when silver stops being expensive and starts being unobtainable. Because when the buy button disappears, psychology changes. And markets never recover from that the same way they entered it. There is a phase in every commodity crisis that most analysts miss, because it doesn't show up cleanly on charts. It happens quietly. On websites. On dealer phone lines. In small gray text that says one devastating thing. Out of stock. This is where the Chinese export ban stops being an industrial story and becomes a public one. Because industrial buyers can negotiate behind closed doors. Governments can intervene quietly. Futures exchanges can change rules discreetly. Retail markets can't. They either have metal to sell, or they don't. And right now, they don't. How retail silver actually worked, until it didn't. For the last decade, retail silver dealers in the United States and Europe relied heavily on Chinese refiners, whether investors realized it or not. Chinese facilities produced sovereign coins, generic rounds, kilo bars, and 100-ounce bars at a scale and cost Western mints couldn't match. Dealers placed bulk orders through trading houses in Shanghai and Shenzhen, waited 4 to 6 weeks, and inventory arrived like clockwork. That system kept premiums contained. It kept the illusion alive that silver was liquid. As of January 1st, that pipeline was severed. Dealers who were expecting January shipments are now receiving cancellation notices. Same language. Same excuse. Same finality. No export license. No shipment. No ETA. So dealers pivot, just like industrial buyers did. They call US mints Canadian mints. Private refiners. And they discover the same thing everyone else is discovering at the same time. Those facilities are already overwhelmed. The U.S. Mint is running at capacity producing American Silver Eagles. Private mints are running 3 shifts. Backlogs stretch months. There is no surge capacity hiding behind the curtain. The premium spike is not the story, it's the symptom. In late December, before the export ban went live, average retail premiums over COMEX spot were already elevated, around $18 per ounce. As of January 2nd, the script reports premiums exploding to $32 to $45 per ounce for any dealer with inventory left. Some sovereign coins, Canadian maple leafs, Austrian Philharmonics, are being quoted at $50 plus premiums for immediate delivery. Now do the math. COMEX spot, roughly $79 per ounce. Physical retail price, $119 per ounce. That's not volatility. That's bifurcation. 2 prices for the same metal, one for paper, one for reality. And here's the mistake casual observers make. They think the story is about the premium. It isn't. The premium is just the last visible signal before something far more important happens. The moment that changes everything. When dealers run out of inventory completely, the premium doesn't go higher. The buy button disappears. You can't overpay for something that isn't for sale. This is the phase the script calls unobtainium. Silver becomes unobtainable regardless of price. You can have $200 in cash and still be unable to buy a single 1-ounce coin, because there is nothing to sell. And when that happens, the psychology of the market changes permanently. Investors who were waiting for a dip realize there will be no dip. Investors who thought they had time realize they don't. That realization triggers panic buying, not because silver is cheap, but because it's vanishing. And panic buying drains the last remaining inventory faster, accelerating the timeline to total unavailability. This is not speculation. This is how shortages behave when trust collapses. The self-reinforcing spiral. The script lays it out cleanly. Chinese export ban cuts dealer supply. Supply cuts spike premiums. High premiums signal scarcity. Scarcity triggers panic buying. Panic buying drains inventory. Drained inventory proves shortage. Proof validates higher prices. Higher prices attract more buyers. And the cycle feeds itself. We are not at the end of that spiral. We are at the beginning. The export ban was the trigger. The next 4 to 6 weeks are the acceleration phase. By early February, the script argues, the retail silver market may be effectively closed to new buyers. Not expensive. Closed. Why this bleeds into the real economy? At this point, it's tempting to think this is just an investor problem. It isn't. Silver is not a store-of-value asset that sits quietly in vaults. It is a functional metal embedded in modern life. And when retail market seize up, it's often because industrial markets are already panicking underneath. Which they are. Automotive manufacturers use silver in battery management systems, power electronics, and charging infrastructure. EVs alone consume hundreds of millions of ounces annually. Solar panels require silver paste for electrical contacts. There is no commercial scale substitute without efficiency loss. Electronics, from smartphones to servers, depend on silver bonding wires and solder. Aerospace and defense systems require high-reliability silver components. Medical equipment, from imaging to diagnostics, cannot simply wait for supply to normalize. When all of these sectors realize the shortage at the same time, procurement panic becomes systemic. And systemic panic doesn't stay contained. Factories delay expansion. CFOs cut capital expenditures. Production forecasts drop. Layoffs follow. What begins as a metal shortage becomes an economic contraction. And when economies contract, central banks respond the only way they know how. They print. The macro doom loop. This is where the story echoes history. 1970s oil crisis. Different commodity. Same structure. Commodity shortage. Industrial slowdown. Recession pressure. Monetary easing. Currency debasement. Higher nominal commodity prices. Deeper shortages. Printing money does not create silver. It just makes each ounce more expensive. Which pushes the system further into imbalance. In part 5, we're going to pull back and look at the strategy behind the timing, why January 1st mattered, why the vault levels mattered, and why this wasn't just resource nationalism. It was industrial coercion. And once you see that, the final move becomes clear. Because this crisis isn't just breaking markets. It's reshaping where factories will exist for the next decade. There's a temptation, especially in Western commentary, to frame what just happened as chaos. A disruption. A policy miscalculation. An overreach that will eventually be walked back. That framing is comforting. It's also dangerously wrong. Because nothing about the timing, structure, or enforcement of China's silver export ban looks accidental. It looks calculated. Why January 1st was not a coincidence. China did not choose January 1st, 2026 at random. They chose it because it is the moment of maximum leverage. By the end of 2025, several conditions were already in place. COMEX registered inventory had fallen from roughly 94.6 million ounces in January 2025 to 38 million ounces by December 27. Dealer inventories were already depleted, delivery delays stretched into months, and premiums were elevated. Western manufacturers were operating on just-in-time inventories optimized for a world where Chinese silver always flowed. China watched this in real time. They didn't need to guess. They tracked the depletion curve. They saw the stress. They knew Western buyers had no buffer left. If the export licensing system had been enforced in January 2024, the West could have adapted. Inventories were higher. Vaults were fuller. Contracts could have been renegotiated. Governments could have intervened early. But enforcing it now, with vaults thin and supply chains stretched, turns inconvenience into crisis. This is the difference between pressure and paralysis. The offer hidden inside the threat. Here's the part that makes this more than resource nationalism. China is not hoarding silver just to hoard it. They are redirecting it. The silver that used to leave China now goes to domestic manufacturers. EV producers. Battery giants. Solar companies. Electronics firms. Aerospace contractors. Strategic reserves. And the message to Western corporations is subtle but unmistakable. If you want guaranteed access to silver, build here. Not as a threat. As an option. Samsung's leaked memo, mentioned earlier, notes preliminary discussions about joint venture battery production in Guangdong. That's not coincidence. That's leverage converting into capital attraction. You want silver. You want predictable allocation. You want supply certainty. Operate inside the system that controls the metal. This is not trade policy. This is industrial gravity. Why the West can't retaliate symmetrically. In the 1970s, OPEC weaponized oil. The West eventually responded, painfully, through diversification, efficiency, and new production. But silver is different. China's position is asymmetric. China is largely self-sufficient in food. China controls rare earth processing. China dominates refining of multiple critical minerals. What does the West withhold in return? Soybeans. Hollywood movies. There is no symmetrical pressure point. Which means this is not a negotiation between equals. It's coercion with deniability, executed through licensing requirements and compliance thresholds. Clean. Legal. Effective. The permanent bifurcation. Even if China reversed the export ban tomorrow, the damage would already be done. Trust has been broken. Supply chains don't forget near-death experiences. Samsung, and every Western manufacturer watching this unfold, now understands a brutal truth. Chinese supply is conditional. It can be turned off overnight. It can be throttled by bureaucracy. It can be weaponized without warning. So what happens next is predictable, even rational. Western firms will try to build non-Chinese refining capacity. Sign long-term contracts with Australia, Canada, Mexico, and the US. Vertically integrate into mining. Build strategic reserves. But here's the catch. None of that solves Q1 or Q2 of 2026. New refineries take years. New contracts help later. Strategic reserves require buying metal now, and there isn't enough to buy. So the bifurcation locks in. China has silver. China allocates silver. Chinese manufacturers get priority. Western manufacturers compete for leftovers. This isn't a temporary dislocation. It's a new structure. From commodity crisis to economic trigger. At this stage, the silver shortage stops being a metals story. It becomes a macroeconomic one. If electronics firms can't source silver, production slows. If EV manufacturers can't source silver, vehicles don't ship. If solar companies can't source silver, capacity targets are missed. Factories idle. Expansion plans halt. Capex gets cut. Layoffs follow. Consumer demand weakens. And then central banks respond, because that's what they always do. They cut rates. They restart quantitative easing. They inject liquidity. But liquidity doesn't create silver. It just devalues currency. Which means silver prices rise further in nominal terms, deepening the shortage and reinforcing the cycle. This is how a commodity shock becomes a recession trigger. The final compression of time. The script ends with a timeline, and it's worth sitting with it. What was expected to peak in late February is now accelerating into late January. Vault depletion that was supposed to take weeks may occur in days. Windows that once looked wide are narrowing fast. The market is no longer moving on information. It's moving on availability. And availability is disappearing. The quietest warning. The most important thing about this moment is not the price targets, the charts, or even the vault numbers. It's the silence. The denials aren't public press releases. They're emails. They're quiet refusals. They're contracts quietly voided. By the time this becomes a headline everywhere, the metal will already be gone. That's how real shortages work. They don't announce themselves loudly. They simply stop responding. And when the world finally realizes that a critical material has become unobtainable, not expensive, unobtainable, the adjustment is not gradual. It's violent. The January 1st export ban was not a warning. It was the action. The reports are real. The denials are documented. The shipments are blocked. 400 million ounces annually, removed from global trade. COMEX inventory at historic lows. Industrial buyers panicking. Retail markets shutting down. This is no longer a theory. It went operational in 36 hours. History will likely mark this not as the silver shortage, but as the moment global manufacturing realized that supply chains built on trust, without control, are fragile. And fragile systems don't bend under stress. They snap.